Hello, everyone. My name is Philip Palumbo, the host of the Palumbo Pulse podcast, where we introduce and interview some of the most successful economists, market strategists, portfolio managers, and business people to get their perspectives on the economy and the market. So today we have with us Veneta Dimitrova, who has 20 years experience as an economist. She's currently senior economist at Ned Davis Research, which my firm utilizes their research platform, which has been extremely helpful. She does really great work in economics, and we're super excited to talk to you today, Veneta. So thank you for your time. Appreciate it.
Thank you for having me on. It's my pleasure, and thank you for your business.
All right, my pleasure. Thank you very much. So if you don't mind, Veneta, maybe quickly, Ned Davis Research, right? How long they've been around? I believe they've been around since 1982. Ned Davis. Maybe just like quickly, if you don't mind, give the audience an idea about Ned Davis.
Sure. Ned Davis Research is a global provider of independent investment research that uses a blended or fusion, if you will, approach to analysis. What we do is we take fundamental, macro, sentiment, and technical analysis, and we combine it to create objective indicators and models that we use, and we create unique insights for clients so that they can make informed decisions. So what fundamentals and macro do is tell you how markets should be acting, while sentiment and technicals are showing you how markets are in fact acting. So by combining those two sometimes contradicting approaches to research gives us a weight of the evidence approach in what we call a 360-degree, if you will, analysis that gives the full picture of where things stand in terms of the economy and markets, so the clients can make a better judgment. The firm itself has been around since the 1980s, like you said, and the namesake, Mr. Ned Davis, is still with the firm actually, and his insights on the economy and markets are absolutely invaluable. But more than that, the principles on which he founded the company, the basic principles, are still our guiding principles to research, like be objective, disciplined, but also flexible, be mindful of risk, beware of crowds at extremes, don't fight the Fed, all of these things. So we apply them to all kinds of research, including to U.S. macro, which is where I come in.
Love it. So it's interesting how you said fundamentals and macro, balancing that with technicals, right? Like technicals tells you here's where we are today. Fundamentals and macro may tell you a different story. So in your experience, though, I always feel like everything in life always comes down to the fundamentals, even though it may not feel right at that moment. So from your experience, you have a fundamental macro view at any given point throughout your career, but yet you look at the technicals and it tells a different story. Do you feel that fundamentals and macro eventually really do end up being correct and accurate, and technicals are more short-term, and it's not really reading what the fundamentals and macro are telling you? Or do you feel it's the opposite, where technicals normally wins the race over fundamentals and macro?
Well, it's different at different points in the business cycle, right? But what we know is that markets do tend to lead the economy. So markets do price expectations, and for one reason or another, we do end up moving in many ways where markets have already priced us to be in the future. That's why markets tend to bottom ahead of the end of recessions, or peak before the economy enters in recession. So not every peak and trough in the stock market would indicate a cyclical change in the economy, but most have, right? So you can't really say that always sentiment and technicals lead macro and macro always lags. They do go hand in hand many times, and the trends that macro gives usually a stronger and longer lasting, which sometimes tends to move the markets in the direction where macro is telling that the economy should be.
Right. So I'm so happy you said that in terms of markets trough before a recession is over. And I love that you said that is because what I'm trying to educate my clients on is the idea that, yes, I personally do believe, we'll talk about that, we're going to go into a recession. But I'm telling clients, like we have to start buying into, right, risk assets, right, as we get declines in markets, because if you're waiting for the recession to come and be over, it's going to be way too late. So that is such a key message I'm really trying to educate my clients on. Even when I'm out there in the media, I'm talking a lot about that, right? Because you do want to get ahead of things, because the market does get ahead of where the economy is going, which is very true. So so I appreciate you saying that. Everybody is so obsessed about this recession call, no matter who you speak with. Oh my gosh, I'm so sick of talking about it, but I have to talk about it, right? But
we have been talking about it for over a year, right? I mean, it's the most spoken and anticipated recession in history.
That's what I want to ask you about, right? So, I mean, from your experience, are recessions like what we're anticipating now always the norm, or do recessions happen where we're least expected?
Yes and no. Recessions and expansions are natural parts of the business cycle, right? Whenever there is some sort of excess that has built into the economy, recession usually clears that excess. If there isn't one, then you could talk of slowdown in growth, let's say, but until that excess builds up to a level that needs to be corrected by market behavior, you will generally not see a recession. Where we stand now, having spoken about a recession since, I don't know, the beginning of this year, perhaps.
Exactly.
This becomes a very anticipated event, which doesn't mean that it won't happen simply because we've spoken about it. It just, from where we stand now, there aren't that many, or there aren't any, in fact, excesses that have built into the economy that will make a contraction of any sort similar to the great financial to the global financial crisis, let's say, or overinvestment, like in the housing market, that will make the subsequent financial crisis something of that magnitude. So when we talk about a possible contraction or a recession, usually the first one that comes to mind is the last one we've been through. Excluding the pandemic, that's the Great Recession and the global financial crisis. So coming from that point of view, the talk of recession and anticipating one makes everyone kind of anxious at this point in time, right? But it's necessary to keep in mind that conditions now are very much different from what they were in 2007, 8, 9, right? So we cannot anticipate a repeat of that deep, prolonged recession at that time. Neither the banks are in as terrible a financial condition as they were then, nor are the balance sheets of households and businesses as in dire strait as they were then. So if we were to get a contraction, which for now seems to be where the economy is headed, in my estimate, it shouldn't be as deep as other recessions.
I agree with you. I agree with you. So, so your feeling is, with this current potential recession that may or may not be coming, let's assume it does come, in your view, what's different this time around is you feel like there are not excesses. Is that correct?
In terms of balance sheets, yeah, basically, I mean, there are some excesses in terms of demand because there was so much stimulus that was thrown into the economy. So there's excess savings to keep the imbalance between demand and supply going for a while. So from that point of view, that is sort of an excess from a macro point of view, right? But in terms of balance sheets, I don't see the same excesses that were present in 2007, 8, 9.
So you mentioned balance sheets, and as you know, and there's so many different articles out there, we're all saying there was $2 trillion from stimulus in the beginning of this year. Now there's around $1 trillion, so $1 trillion has been spent. Other articles are saying 600 billion. Who the heck knows what the right number is, but it's somewhere between 600 billion or $1 trillion. So my question to you is, if there is that number, then why is credit card debt going parabolic?
Well, there is savings and there's willingness to use those savings, right? There are
Right.
two things. The first one is distribution. Those savings you mentioned, this is the aggregate number. This good series from the financial accounts of the United States, which is the exflow of funds from the Fed, that shows the demand deposits of households. And this is what I use to gauge the aggregate level of cash available to households. There was also the distributional accounts of the U.S. that shows how these savings or demand deposits, or rather, distributed across the wealth curve in the U.S.
Right.
From the lowest quintile of that wealth distribution has actually used up all of those savings. Their demand deposits now are lower than they were prior to the pandemic. In fact, they're going back to as low as what they were during the previous recession. Across other segments of the distribution, though, savings are still there. They're being depleted, but they're not exhausted just yet. So when I hear arguments about households are sitting on a ton of cash, therefore there'll be no recession, or households at the lowest end have exhausted their cash, therefore there will be recession. These are the two extremes of the opinion, right? The truth is somewhere in the middle.
Right.
So yes, savings are still there. They're not growing as they were because there's no stimulus. Households are saving less, but they haven't exhausted all that they have saved. So for me, that's an argument not for either or recession, but for a deep or shallow one. The fact that there are savings behind consumers, even though some in the wealth distribution have exhausted them, means that there is still fuel that may make a potential recession shallower.
Right. I so agree with that. So that $1 trillion that I just talked about on a lower income scale from a wealth standpoint, that's been spent, and I totally agree with that, even just speaking to a lot of different people. But in the middle tier of that, would you say they spent as well? So most of that money is in the higher net worth area that is, they're not big. They don't necessarily have a propensity to spend like the lower income household, right? Would you say so? Most of that $1 trillion is with the wealthier community.
Yes.
Would you agree with that?
Yes.
And so
that's where it stands. And I also agree with the point. I mean, it is a fact that the higher wealth holders or the higher income earners even have a lower propensity to spend. So the fact that the savings are accumulated there means that there is less impetus that we can expect from that saving to be spent.
Right. I agree with that. So in terms of Veneta, when you do your work, right? I've been very vocal about this, that people are locked up for 2 years due to COVID. Savings was through the roof. And then they got more confident with COVID. They came out in drones. We went from a goods economy to a services economy. And that's where a lot of the consumption has come from. Do you think COVID and the propensity for people to actually spend is going to dissipate over time, and that effect of being locked up and now I'm out spending, but now I got my vacations in, I got my spending at restaurants in, but you know what? Inflation actually is a problem, and now I'm recognizing it. I don't really need to go out I don't need to go on another vacation or two or a restaurant. So you think that whole feeling that people got is going to start to dissipate and reality is going to come into play at some point?
This is what the Fed is hoping is going to happen, right? So when the Fed started raising rates in earnest earlier this year, the sectors of the economy that are most interest rate sensitive, which are usually goods sectors like construction, manufacturing, housing, vehicle purchase, all that stuff, they responded rather quickly to the increase in interest rates. What's happening now is the Fed is hoping that overall demand, which is now services, will dissipate because of the higher interest rates that they have instituted, right? So the general expectation is that overall demand, the aggregate demand, including from consumers, will slow down. And given that the shift is now from goods to services, the general anticipation is that services demand will moderate as well. In terms of shares, goods to services, we still expect that rotation in consumer preference and consumer demand to continue to move towards more services and fewer goods relatively within total consumer spending, but overall demand should grow at a slower pace.
So just so the audience understands, when we talk about goods, we talk about purchasing dishwashers or refrigerators for your home and various other products for your home, which people did when they had no choice but to stay home. So that winded down, and then people got into services. So how do you actually define services? When we say services, just explain quickly, if you don't mind, to our audience, what do we mean by that?
Well, depends on the definition here, right? If we're talking about GDP, that's anything that's not the services industries are the ones that are not mining, construction, or manufacturing. But when we talk about consumer spending, anything that's services related includes shelter, medical care, financial services, recreational services, education, communication, the internet we pay for, all these things.
Travel.
Correct. Yes, travel for sure. Restaurants, definitely. That's
Right.
been, a big part of it. So all of these things fall within the services category of consumer spending.
Okay, so I want to bring this conversation into the job market. So I've been of the view lately, I've been very strong that things are going to get really bad with the economy, markets were overvalued. I've been very vocal about that, and I've kind of been right over the past, I'd say, year and a half. And now that we kind of got there, sort of, I'm looking at the job market and I'm saying, wow, this job market really is tight. Jolts are over 10 million. I've been talking a lot about this. Wages have increased, and we have this cash of $1 trillion that we just talked about. And for those reasons, are we really going to go into a recession when people have jobs? And the job market's so tight because people left the labor force and not coming back, the boomers especially. And for those reasons, maybe the job market stays a lot tighter, and the playbook that we're used to and judging recessions, you throw out the window because COVID imbalanced everything. What is your view about what I just said?
I absolutely agree. It's that's one of the reasons, the health of the labor market, the resilience of the labor market, really through all these rate hiking, is why making a recession call is not an easy feat at this point, right? I mean, we've had 2 consecutive quarters of negative growth in the first half of this year. There was no recession per se because that was driven by the volatility in inventory and net exports. In the second half of the year, there was some dissipation in aggregate demand, but labor markets held through it. If the economy was slowing, nobody told the labor market, right? So, and there isn't really a recession until we see an actual decline in payrolls. In the past, that has been one of the preconditions really for a recession. The thing with the labor market, though, is that it responds with a notable lag to tightening Fed policy, right? So what our analysis shows is that payrolls growth tends to slow significantly in the second year of a Fed tightening cycle. And we're just now, we're still in year one. In Q1 of next year, we will enter into that second year of Fed tightening. And
Right.
given the speed at which tightening has happened, I would anticipate that payrolls growth will slow more meaningfully after that. Yeah, the labor market is resilient, but there is a note of caution here to keep in mind that it does respond, as do many of the industries in the U.S. economy, with a lag to tighter Fed policy. So the full effect of that cumulative Fed tightening is just ahead of us. It's one of the reasons why I'm very skittish about the economy. Why we haven't made a recession call, but a significant slowdown and a recession more likely than not for next year is our base case for now.
Even if people left the labor force and they don't come back. That's
So the
different.
thing with the people who left the labor force is that we have to look at who left the labor force, right? I mean, there's still a number of people who are not coming back for reasons like long COVID, let's say, or their understanding of life has changed, priorities have changed. Some would rather have one person in the household work and the other take care of family members. There's things of that nature, but they're marginal compared to how many older workers left the workforce.
Right.
When you're close to retirement, or you've already reached retirement age but have been working and left the labor force because of COVID, there's little incentive now to come back, right? I mean, fears of the disease in one way or another may still be there. You've already cashed in. The stock market did very well prior to COVID, and since then, in certain periods, there've been asset appreciation across the board for real assets. So people who are able to, to supplement their 401ks and retirement savings that way probably did. So why would anyone come back?
Right.
They're at retirement age and have left the labor force. So some have, but not many. And there isn't an anticipation of that trend reversing. And given the global, the overall demographic trends of the population aging, then it seems like a structural change in the labor force. Unless something else changes that causes labor supply to drift up, let's say an overnight change in immigration laws that somehow brings the type of workers that the economy now needs. Obviously, that's imaginary and not a near-term fix for labor shortages. But if something of that nature were to happen, then yes, labor supply could be changed in a swift fashion. But other than that, demographics and labor participation trends don't change on a whim. So it seems like this labor shortage, labor imbalance, let's call it, in the near term, would have to be, corrected on the demand side, and will be corrected on the demand side first before any changes on the supply side.
Do you think the Fed is going to get what he wants?
Don't fight the Fed. That's one of our rules, right? I wouldn't bet against the Fed. They have been very adamant in, pursuing their goal. If their mandate is 2% inflation, even though they don't pencil it into their dot plot, into their SEPs for reaching it until 2025, I wouldn't bet against them instituting policy to pursue it, right? And Powell has been very explicit in saying that labor market and wage growth is what they're after to balance the labor market. So even before that latest Fed forecast, our projection was already for the unemployment rate for next year to start picking up. We don't see a significant increase in the unemployment rate, but a move up from 3.7 now to about 4.5%. Assuming the recession that we're kind of, giving higher odds of happening than not happening, materializes, and it remains within that realm of shallow, then that will mean about 1.5 million people or so may lose their jobs, which is a significant economic pain, especially if you're one of those 1.5 million people, right? But in the grand scheme of things, it moves the unemployment rate just in line or within the range of what is considered full employment unemployment rate, or NAIRU. And at that point, inflation, by economic theory, the labor market should not be, pressured by this. The wages and inflation should not be pressured one way or another, but by that level of unemployment.
Got it.
So neutral for inflation is what I'm saying.
Got it. So do you buy into the idea that in the 1970s, by the time Paul Volcker took the helm, that inflation was already ingrained into the economy, right? So that's why there was a big fight that Paul Volcker had to go through, and he won that battle. Today, would you buy the idea that inflation is not really ingrained into the economy? Yes, it's problematic, but it's not ingrained in the economy. And because of that, by summer of next year, there's a good chance that the Fed could possibly be close to its target.
it doesn't seem to be as ingrained within the economy. Looking at inflation expectations, both survey-based or market-based, off of the TIPS yield or any which measure you look at, it does seem that both the intermediate and long-term inflation expectations are moving down. The survey-based measures from the New York Fed, let's say, or the University of Michigan sentiment survey, they do show that inflation expectations are very much higher than what they were prior to the pandemic, but they've been coming off their peaks. So in some ways that shows the Fed policy is working to maintain that level of inflation expectations. And they haven't been ingrained yet either in business behavior or in consumer expectations. So the goal, of course, is to move them lower, closer to that 2.5% that they were prior to the pandemic. And I have no doubt that the Fed will do what they can to move inflation expectations towards that level so that they do not get ingrained within the psyche of the economic actors.
So do you believe, where, if you had to bet, where do you see CPI a year from now?
Well, I don't have to bet, right? I mean, we did a projection using a bottom-up analysis, basically, because top-down models did not work so well during the pandemic and are still kind of off. Historical performance doesn't bode well for the for making accurate projections at this point in time. But looking at the individual CPI components and projecting where each one might go over the next year led me and us at NDR at an expectation of 3 to 3.5% CPI inflation at the end of next year. So this is our main goal really for the year. Like when we talk about inflation, though, we have to keep in mind the differences between CPI and PCE inflation. And the Fed is obviously focusing on PCE because from an economic standpoint is the more accurate measure of inflation pressures. But CPI is just as important, right? Because tips are based on it. Adjustments to Social Security payments are done on it. Tax brackets are done on it. So yeah, CPI is just as important, if not more so.
What I want the audience to understand, because I think it's helpful, is so when we talk about CPI, we're talking about really everything, including gas and food, correct?
Mm-hmm. Yes.
When we talk about PCE, we're taking out gas and food, correct?
No.
So the Fed looks at the core CPI number.
Yes. Core PCE does take out food and gas, but the broad PCE price index still includes those two volatile components. Yes.
So the Fed is looking at PCE or core PCE?
Both. They do make projections on both, but underlying inflation pressures, where the total PCE price index tends to go over time, is really the core. The core piece.
Yeah, I got it. So this is the part that I feel like everybody, the investment community, is confused about. So his target is 2%. He keeps talking about that. So, but what target is he talking about? The PCE or the core PCE?
From a year to year, it's the core PCE.
Right.
Over time, core PCE and PCE will tend to be about the same.
Oh, is that right? Okay.
Yes.
Right.
So core PCE, what gives you the underlying inflation pressures. If those are out of bounds and significantly away from 2%, then headline PCE inflation is even more so, out of bounds with it.
So your projection of 3 to 3.5, is that core PCE or PCE? Or
this is our projection for the headline CPI, consumer price.
And at that point, based on that, the core PCE should be definitely at 2.
Or with a 2 handle, let's say.
Correct. Yeah, or with a 2 handle. Got it.
If that projection is correct, then PCE inflation should be high 2%, low 3%. Historically, the gap between PCE and CPI inflation has been an average of 45 to 50 basis points. When inflation has increased or become more volatile, then that margin between the two has also widened. But since we expect inflation to moderate throughout the year, then the gap between CPI and PCE should also narrow.
Yep, got it. Okay, and Could you talk about the overstatement of jobs that we've been reading about lately? What is your opinion about that? And if it is actually accurate that there's an overstatement of 900,000 to 1 million jobs over the past 4 to 6 months, then if that's accurate, then what is the unemployment rate number today? Do we have any idea?
Oh, no, if this is correct, then we have to redo all the calculations, right? But keep in mind that the number of jobs and people working are two different surveys, right? So
Right.
when we talk about the establishment survey creating close to 400,000 jobs a month over the past 6 months, let's say, that's different from the number of people working, right? The unemployment rate is based on the household survey,
Right.
right? And the other one is based on a survey of businesses of how many jobs they hired for. So one is jobs, the other one's people. So there's really not an easy conversion here, right? There is an adjustment to the household survey that is based on the concepts of the establishment survey, and over time, the jobs from the payroll survey and the adjusted household survey should move together as they do, but that's over extended periods of time. From month to month and from cycle to cycle, there may be differences there. In terms of the misstatement of jobs created, I do have to look more into that. You know, it was the Philly Fed that started publishing those numbers, but I haven't personally gone into the individual numbers to see how they track from state to state and from month to month, right? BLS is very meticulous about reporting those numbers. They're I would rather wait and see the benchmark adjustment to know for sure what the actual job creation was.
Exactly. That's going to be a much anticipated number.
Oh, I'm sure.
So Veneta, one last question for you. From your experience as an economist the past 20 years, what have you felt has been most helpful for a regular investor in terms of understanding the economy and maybe the correlation with markets? What's 1, 2, or 3 things that you've noticed, like, hey, gosh, this is like amazing, something that's really been helpful to you as you analyze the economy?
Well, I would say the most important thing is to keep in mind that the market is not the economy, and the economy is not the market. Even profits, when we talk about corporate profits from an economic standpoint, from the national income and product accounts, that is different from the profits of S&P 500 companies, right? Mm-hmm. So keeping in mind the differences and knowing that the market is not the economy is important. But also know that the stock market reflects the general health of corporations, which are the heart and beat of the economy. Right. So keeping that in mind, I find it very useful to know where the market is, not just price-wise, but earnings-wise. Right. And for me, how prices, earnings, and the business cycle move in relation to one another has proven helpful in, helping to guesstimate, if you will, or just anticipate changes in both the markets and the economy. As we mentioned in the beginning, stock prices tend to move ahead of the business cycle, tend to bottom about 4 months before the end of recession, tend to peak several months before the start of recession. The earnings are just the opposite, right? Corporate earnings tend to bottom 1 to 2 quarters after the end of recession. Right. So if that is the case, then we should expect, if there is a recession in 2023, markets to be quite volatile, right? You could expect earning declines or downward revisions to span most of 2023, right? If not all of it, while the market itself could bottom mid-year, something like that. Assuming a recession starts in the first half of next year, right? So it's this volatility that I find exciting, and I think it's it's something that all investors should keep in mind. First, don't keep in mind that the economy and markets are different, but they move in relation to one another, and making a call on either the markets or the economy can be helped by understanding the other hand.
Yeah, love it, love it. You know what I find most fascinating is that if you look at recessionary periods, the average correction in earnings is anywhere from like 1980, it was 1980, 1984 or two, was down 4% peak to trough as far as earnings. And then the Great Recession was down 90% peak to trough. So you have this, the average is about 30% peak to trough. So, and like you said, normally the trough occurs after the recession, but yet the market bottoms during the recession. So it's this disconnect that people, and this is why you get a lot of people say, I just don't understand the markets. I don't understand how this is happening. That they think that, news today and that should be reflected today. No, the market's reflecting what's going to happen 6 months from now, not what's going to happen today. That's so important. But Veneta, you've been absolutely amazing. And thank you so much for your time today. You really were great. I'm so excited to have you on. Thank you very much.
It's been a pleasure. Thank you for having me on, Phil.
All right. Thank you. Thank you, everybody. So look forward to our next Palumbo Pulse podcast, which will be over the next couple of weeks. Thank you for your time today.